Investing in stocks versus bonds is risky, and that risk is moving around over time. During the Brexit period, the volatility on stock and bonds went through the roof. However, there are other times when volatility is much lower and the markets are calm. What the variance risk premium is, it tells us something about what investors are willing to pay to avoid the fact that this risk varies over time. What we typically think about now in the bond market is that there is some sort of underlying uncertainty which rises and stocks tank. At the same time, people want to get their money out of stocks, so they buy bonds. Bonds hedge against this uncertainty, they hedge against the negative shock in the equity market. Somewhat surprisingly, we find that the variance risk premium on stocks is massively driven by shocks to expected inflation. Why is that the case? Well, it comes back to what I said about stock-bond correlation being time varying. It used to be positive and now it's negative. And one of the explanations for this is that now we live in a world of deflationary recessions. So when we're in a recession, if we observe a series of small shocks to expected inflation, we believe the market is taking this as a signal that we may get out of the recession. Now, if we're getting out of the recession, risk aversion goes down, and this drives the variance risk premium down. So all of these stories are linked, and the common denominator is expected inflation. I think the key takeaway from this paper could actually be for policy. Why? Because one of the messages of the paper is that expected inflation is driving everything. Now, to the extent that monetary policy influences expected inflation, policymakers should take note.